Okay, so today we've got accountant meets financial planner on the Century Plan. We're joined by our friend Rob Nicholls, who is a seasoned CFO, non-executive director and board advisor. Rob, you've got over 35 years global finance expertise, I believe, which you use to support businesses in scaling their operations, maximizing profitability and creating sustainable value. Um, you're based in the UK now, but I know you spent a chunk of your career in the US, and you can tell us how long that was in a minute. And it'll be interesting to hear how that shaped your thinking. So, Rob, can you tell us a bit about your background, your time in America, and what's led you to doing what you're doing now?
Sure. It's good to join you today. Nice to see you, Sarah and Dennis. Yeah, I've been doing this a number of years now. I've been back in the UK about 5 years now. My role, you guys work with individuals generally. I tend to work with organizations, smaller organizations, SMEs, working with the management team, CEO, managing director, partners, really to scale operations to increase the volume of sales, margins, profitability, and to create value. So for me, that's what it's all about. It's working with business owners today to scale their business. And as I say, I've been doing this 5 years back in the UK. Prior to that, in '97, we moved out to the US, to the West Coast. I was the CFO for a large section of a technology company, and they wanted someone with some international experience to go out there. And I became an expatriate, which was a very different experience from what you have in the UK, where you pay your PAYE, your national insurance, and that's about it, kind of thing, and you contribute to your pension. In the US, it's a bit of a free for all, and as an expat, you're basically paid in a different currency from which you're spending your money. So I was paid in pounds, so I was exposed to an exchange rate against the dollar. I was paid my expenses in dollars. All my expenses, mortgage, housing, utilities, and so forth, were in a different currency. So I became a little bit of I wouldn't say an expert, but I know how to game the currency markets these days after 25 years of doing that. Um, and learning that playing with currencies is a good way to take a large amount of money and make it a small amount of money.
A lot of risk. A lot of risk in currency trading.
It's tough. It's tough. And my favorite thought is that the trend is your friend. And so you follow the trend. If the pound is getting weaker against the dollar, you act accordingly and so forth. So that was one of the early learnings I had as an expat, was that companies as well as individuals need to understand how to manage their exposure to risk. And for me, a big part of that risk was currency risk. But we spent 20 plus years over there. We bought houses, we sold houses, we bought jet skis and all sorts, and we had holidays, and we spent an awful lot of money over there. But I also kind of honed my investing acumen, if you will. I bought and sold businesses for my employer individually. I invested in businesses. So I've done a lot of different things, using other people's capital, using my own capital, and generally having a bit of fun with it.
Good. Well, as you were talking, I recall that I spent some time. I lived a year in Moscow, so I had three currencies to play with. One of them was a basket case currency called the ruble, but sterling and dollar feature quite strongly when you leave these stores. Certainly, dollar, that's sort of the world's currency. But yeah, I never really wanted to get involved in currency trading.
And for me, it was about acquiring assets in currencies that can generate an income as well. So whether that's housing or businesses, whether in the UK or the US, it's about generating income, whether it's a dividend income, property income. It's about acquiring assets over time that enable you to generate what I call passive income. So whether that's I have a house here, I live in it, I have a house there, I rent it out and generate income. And so long as those incomes will accrete to you, that you don't have inordinate amount of costs over time, that income will become more valuable to you as well. And it's the same with any asset, whether it's generally commodities don't generate returns, but property, equities, shares, bonds, anything that will generate an income over time, I want in on that sort of thing.
Yeah. Now, as you were saying that, and there's people who've set up their own businesses and acquire assets, there's this phrase that income follows assets. And I think Daniel Priestley, who we've both spoken about before, and certainly every time I've gone to one of his presentations, that phrase will come up: income follows assets. So it's all about building your asset basis. You know, as you're if you're a serial entrepreneur, you'll be building up sort of asset bases or turning your money into something that might generate an income. I don't want to follow that line of questioning right now, though. What I want to do, you've worked with people who are, we would hope, good at building businesses, whether it's one or several. And I guess that you've met quite a lot of those people and they've exited quite comfortably over time. So do you think that their success in building a business or a series of businesses makes them better investors in the wider world? Or might it actually be a hindrance in that they believe they're probably better investors than they really are?
I think they're very different skills. I mean, I've met some poor business people who've got personal financial acumen. And there are also people I've worked with both in the UK and the US who have made an awful lot of money. They've hit upon a good service or a good product and they've sold a lot of it, generated a lot of value, potentially exited or inherited wealth, but they're absolutely lousy at personal financial management. They either spend too much or they raise too much debt or they just acquire assets that are depreciating assets, generally things like cars, boats, and so forth. So I don't think there is a line that you can connect a good business person to good personal financial accountability acumen. Some of the strangest, oddest people that you wouldn't think are good business people are actually extremely good with money. They understand the value of time. They understand the idea of postponing enjoyment of the asset. £1,000 today can be £6,000 in 20 years' time. You build returns on top of that. It doesn't matter how successful you are in business. Some of the most successful financial people personally haven't had financial success in business. And so I don't think there is a line that you can draw between the two. I've met some very, very successful business people that I've worked with that have very successful businesses and created a lot of value, but they're absolutely rubbish at personal financial management. They're either going through relationships, getting divorced, severing assets, losing pension plans, losing retirement funds, and then they have to start again in their 50s. That's tough. That's really tough. And I've met a lot of people that have had to start again and had to build assets from the late 40s, 50s, and they've still got alimony, education fees, and so on and so forth. We'll talk a little bit about, we'll all be working a little bit longer in life, but I would rather work longer because I want to work longer and because I can, because I'm healthy, rather than having to work longer because I have to, because I'm 65, 68 years old and my kids haven't even gone to college yet. And I don't have a lot of money. I don't have a lot of assets, but I have a lot of debt.
Yeah. So we want to reach a point of financial independence because that gives us choice. Then we can choose to work. And I know we've talked about that in the past. I suppose a lot of those people stay very heavily invested in what they know, the self-made business person. And probably as somebody who works with them, you get sweat equity in some of those businesses. What point or what percentage of your wealth do you think is sensible to be invested in what might be micro businesses, small businesses, or the sweat equity of somebody else's versus the big, the healthy big companies of the world that we should be, we talk about.
Can I just check what this sweat equity is?
You're exchanging your
Effectively,
sweat.
I would defer a
as it
piece of my
sounds.
income for a share of another business. So, instead of taking £1,000 retainer on a monthly basis, perhaps I'll take 0.1% of equity or shares in a business, and that's often a good. That can work for you. It's worked for me in the past. I wouldn't do it today because I've got certain investment profiles and timelines that doesn't work for me. But back to your original question, Dennis, I think an awful lot of people think that their business is their pension plan, or that's everything to many people, and I think that's a very poor decision generally, because you just don't know how a business is going to be impacted by the environment that we find ourselves in 3, 5, 8, 10 years. You might have a business today that's worth 10 million, but quite quickly, if you have the wrong people doing the wrong things, or you lose a couple of key clients, you could have a business that's turning over 1/10 of that and perhaps is worth 1/20th of that. So I don't think you should have more than about a third of your total wealth wrapped up in a business that is yours, that is dependent on other clients. You need to have, in my world, you need to have generally 4 to 5 income streams. One of those should be or could be your business, your primary business, whether it's a limited company or a sole partnership or a sole tradership. But you need to have multiple income streams beyond your 9 to 5, Monday to Friday business opportunity. You need to have multiple streams, whether that's property, equities, trading, a side gig, whatever it may be, holiday homes. I'm not a big believer, to be honest, in property. It's the easiest thing to invest in because people think they understand property, they understand holiday homes and the like, and it can work for some people. I've owned property for 40 plus years, and there's a lot of expenses involved in owning property and managing property, and things wear out. I'm not a big believer in property going forward. I think we've had a lot of property appreciation both in the US and the UK. I'm not sure that we're going to have that level of property appreciation in the next 20, 30, 40 years. I think there are other assets that will probably do better in the environment we're going into.
And I think if we look at equity, global equities, they've probably done better than property over most medium to long-term periods.
Yeah. I'm a strong proponent of having a portfolio of various companies diversified across markets, industries, countries, both startup businesses, medium, mature businesses, and businesses that have been around for decades. And you need to build, I think, a broad portfolio of assets, and equities, to be honest, probably should be the core of most people's, I believe. It's worked for me. I think it's worked for a number of people. I've been trading and investing for 40 odd years. I first bought stocks when I was in high school, and I do it to this day. I put a position on just yesterday in the US. So I don't think you can beat passive investing in things like the S&P 500. I think people really should anchor their investments around those sorts of things and do it automatically every month. Every time you get a paycheck, every time you get a salary or a bonus, put 50% of it into the bonus, into equities, and just leave them. Put them into a tax wrapper and let them build with time. I'm of an age now when I've probably got 20, 30, 40 years perhaps of more investing to go. My kids have got 40, 50, 60 years of investing. My goodness, £1,000 invested in the S&P 500 today is going to be worth an awful lot of money in 25 years' time. We've seen it happen. I don't, to be honest, understand the mindset of people who don't do that. But
you've had that experience of doing it for quite some time, and we've had that chance to talk about this, outside of this forum. So, but our viewers, they don't know you.
Mm-hmm.
So I just want to say for people who are listening that Rob is successful and he's reached that point of financial independence where I think most of your life is now spent on a golf course.
It is.
Um, and the hard work of investing isn't because you've automated it. There's no thinking involved. If you're buying index funds,
Right.
you just, as you say, I've got some money, it goes in there. All the thinking was done years and years ago. The mindset about why do I want to be a particularly active investor in the market when I can just buy some passive funds and enjoy life the way I
But it
want
is
to?
difficult, and it is deferring enjoyment and pleasure because you're putting money away today and you're not going to get the pleasure of that for 20, 30, 40 years. But deferring that enjoyment of your income or bonuses and so forth is so worthwhile. And to be honest, I wouldn't change anything I've done over the last 20, 30, 40 years. I've made lots of mistakes, made lots of money, lost lots of money. But I know that over time, and what I encourage my kids to do is to automate it. Is every time you get paid, put a proportion of it, whether it's 3%, 5%, 10% or more, into an investment and automate it and just build on it year in, year out. Let compounding happen, and invest it wisely. Invest it wisely. And one thing that I, because I'm an accountant, I understand money, is that I don't like to pay a lot of fees for my things. So I tend to do the low cost route in terms of I buy relatively low cost trading vehicles that allow me to buy something for 5, 7, 8 basis points and then spread that across time. And it's very, very inexpensive to do things. Now, at the same time, I'll still put on trades. I bought a trade yesterday in Reddit, which is a social media platform. It won't do anything. It'll probably go up 10% and down 20% in the next year or two. But I'm pretty sure over the next 25 years, that will grow into a significant investment opportunity. But I don't have the access to those funds anymore. I've deferred the pleasure and enjoyment of using those funds, knowing that in 20, 30 years' time, that'll be likely significantly more valuable than it is today. And
So
it is
you
about
will
deferring it in
spend a
pleasure.
little bit on an individual stock rather than an index fund.
Yeah, and I don't do
Would
it
that be your
often. I probably do it only once or twice a month now, is individual stocks. I really do believe in picking aggressive funds, whether it's in a pension or an ISA, or I have multiple funds in the UK and the US. In the UK, it's all about pensions and ISAs. In the US, it's all about my rollover 401k, my Roth IRA, my UTMA, my IRAs, my 401ks.
Should we talk about ISAs and pensions?
It's just ridiculous pensions here. Um, when you're a dual citizen like me, you have obligations and you can vote, but you also pay taxes in both countries as well. So it takes a little bit of managing. But I think, to your point, I think you mentioned earlier, is you've got to have the time and energy or knowledge or partner with someone that has the time, knowledge, and experience to help you be successful. I can do it myself. A lot of viewers, a lot of listeners need your help, need your guidance, need your insight and wisdom and counsel to make better decisions for them. Because in the long run, 20, 30, 40 years, it will be highly beneficial for them and their families to have done that.
You're a great advocate for our last podcast then, really, which was visualizing your future self. We were talking about people struggling to connect with themselves in 20, 30, 40 years' time. Perhaps they just need to speak to somebody who has done it and can say how glad they are.
It's so difficult. Envisioning is so difficult. It's a learning in and of itself. You know, when I play golf, I envision what shot I want to play, where I want the ball to be for my next shot. And I think, it's very difficult to imagine yourself 20, 30, 40 years on. But I kind of knew what I wanted to be able to do when I'm into my 50s. I wanted to be able to do what I want to do, when I want to do it, and do it with whom I want to do it. And so I tried deliberately to focus on deferring pleasure and enjoyment in my 20s and 30s financially, but I got to do a lot of things because my company enabled me to travel and we got to see a lot of places and do a lot of things. But at the same time, shoveling money into things that enabled me to live the life I want to live today and tomorrow and the next 5, 10 years. But you do have to defer enjoyment. I could have had bigger boats and more jet skis and more cars and bigger houses.
Where were you in the US, Rob?
So I spent the best part of 2 decades in Arizona, but I spent a lot of time in California, the whole of the southwestern US. So we spent a lot of time down in Mexico, California, the mountains in Colorado, skied in Colorado a lot. But most of my time was in Arizona. And it's a different world. It's a different planet. It's a different way of thinking. Business is done differently. Things move faster than they do in the UK. There's more liquidity. There's more markets. There's more opportunity. It was a good experience. But now I'm back in the UK and I love it here. I love the people. I love the opportunities. But it was a good experience. It was a good experience.
Worse weather.
So there was a question I was going to ask that you've already answered, but it leads me on to another one, which, as an accountant, I'm an accountant. I understand money and costs, and you were talking about costs, that was going to be my question. But we're approaching the budget right now, and I'm getting lots of people talking about, well, speculating on what the tax changes might be and wanting to make some fairly big potential decisions that could go against them. What is the government going to do about this tax, that tax, and the other thing? What would you counsel as an accountant? How do you counsel people who may want to make big chunky decisions to try and second guess a government and a tax change?
I'm not sure if it's fool's errand, but it's probably not a wise move to try and front end things that you just don't know about. I mean, for example, there's an awful lot of positioning right now ahead of the US elections in November because we just don't know what capital gains tax is going to be, what tax rates are going to be, what tariffs are going to be put in place if they were to be. At least we have a level playing field in the UK now. We kind of know where we're going for the next 4 to 5 years. Yes, there's a budget coming up in the next few weeks, and that will make some fairly big changes to things like capital gains taxes and perhaps other pensions potentially as well. I'm minded that over, sort of an investing journey of 30, 40 years that I've had now, both Conservative, Labour, Republicans, Democrats in the US, it largely doesn't change your orientation. You know where you are, you know where you want to be, and it's a matter of taking hold of the things that you can influence within your control, whether that's fees, whether that's the amount you invest or the longevity of that investment period. You just have to recognize that there'll be Democrat presidents, there'll be Republican Congresses, there'll be Labour governments, there'll be Tory prime ministers. I think if you understand and envision where you want to be in 20, 30, 40 years' time, automate what you're doing, whether it's investments, whether it's putting money into a pension on a monthly, quarterly basis, making inheritance or gift aid to members of your family, helping other people, acquiring assets. I think you largely have to tune out the noise around policy changes that may or may not happen this year, next year. Generally, over time, assets acquired go from bottom left to top right. They go up in value over time. There's squiggly lines up and to the down. We have downsides, we have ups, we have bubbles, we have recessions. Generally, I think if you can automate things and put £100 or £1,000 a month, and maybe when there's a recession, knowing that asset prices are depressed, maybe you double down at that point. And when there's a bubble, right now there's a bubble in AI stocks. I sold my Nvidia stock 6 months ago, but I'd made plenty, but I missed an awful lot of the upside in the last 6 months. Equally, in 2008, 9, 10, I bought a lot of US stocks that were beaten down, that were penny stocks, $1, $3 stocks that today are 3 and 4 digit number equity values. So I think you just have to try and tune out the highs and lows, recognize that things generally over time compound at a single digit number, whether that's 5, 7, 9%. Diversify your assets across asset classes, whether that's commodities, currencies, property, equities, private investments, your own company, whether that's classic cars, wines, whatever it may be, holiday homes. You need them all, and you need to acquire them over time, not just at one point in time when you're in your 30s, when you've got a mortgage and perhaps children as well, but over time, and just tune out those political noise, economic noise, and just stay a path. It's tough to do. It's really tough to do when you lose half of your asset values in 2007 and 8, and companies are collapsing around you, and it really was the end of days. But knowing that it generally does get better, Dennis, it does get better.
It does. Well, you don't have to tell me that. And I was hoping you would say that, because I asked that question not knowing what your answer was going to be. There's nothing rehearsed here. So we're on the same page. But you are an accountant. You're not a financial planner. You don't advise people on the retail side.
I'm not FCA regulated. I'll tell you what I'll do, but I can't advise you.
For you, therefore, as someone who's a DIY investor, and we're seemingly, well, we're close. I mean, you're talking about buying wine potentially as an investment in classic cars, which is not anything we really talk about with our clients, although one or two have. But for you, was there a specific aha moment that said, I'm going to stop being a speculator and start being an investor, and I'm going to be and I want to have a large chunk of my wealth in low cost index tracking investments? Was there an aha moment, or was it a slow realization?
So to be honest, there was. It was a slow process, but there was an inflection point. I came back into the UK in 2019. I was of an age where I had been doing a lot of trading and investing for 25 years in the US. And I just kind of said to myself, yeah, that was a time that worked. It was good, but I don't need to do that anymore. And what I wanted to try and do was lower my cost of being in the market, and basically just take what I think is the market, the S&P 500. And if I can get 5 to 8% compounded over time in a tax deferred wrapper, that's me happy. I don't need to make 10-fold, 20-fold on a private investment and then pay 40% tax on it, and capital gains tax, and again getting into another tax bracket. So I was very mindful of taxes. As an accountant, you're very mindful of taxes. My father once wisely told me that tax avoidance is good, tax evasion, you don't want to do that, Robert. So, just being mindful that paying some tax is okay, but educating yourself as to the best way to develop wealth through compounded returns in tax deferred wrappers. I can buy a position in Reddit, but it's all acquired through tax wrappered accounts in the US. So it's in a rollover 401k, for example. I'll never pay any tax on it. And I think that's where you want to be. You don't want to be giving money to the tax man as an accountant. It's just not something I want to do. But you want to maximize the wealth you accumulate over time. So that means low cost fees. That means you need someone to guide you. I guide myself, a DIY investor as it is. Most people, they need someone like yourself, Dennis and Sarah. They need that guidance. They need that counsel, that insight, that knowledge, that experience, because they don't have it. And you've got compounded knowledge from multiple people, other people in those circumstances. I've done it all myself, and I've lost plenty of money along the way, and I've learned an awful lot, because that's how you learn, isn't it? You kind of
It is,
make
yeah. I don't think
mistakes.
anyone goes through this life without scraping their knees a bit.
Plenty of my
But I
businesses that
suppose
I've
just asking
invested
that
in have
question,
gone bankrupt as well.
yeah, that happens. Would you have, I mean, had you known, do you think you would have applied that philosophy earlier in life?
Yes, I think I should. I mean, I counsel my kids who are in their 20s now to avail themselves of people who can advise them accordingly on certain skills. Like if they don't have a skill to do whatever task it is, find someone that has that skill to work with them. For me, I've always been around finance, whether it's personal finance or company business finance. It works for me. That's my gig, if you will. But I'm useless at everything else. I can't do electricity, home extensions, roofing, whatever. I can't do those things. So I have people to do those for me. So I think that's something that I've learned, is that you figure out what you're good at and what you're passionate about and do that. And for everything else, find someone to do it for you, because it's money much better spent. Um,
No, it is.
I play around in a lot of different games, whether it's marketing strategy, logistics, productivity, HR stuff. But I'm a finance guy. I look at things through a finance numbers perspective. And when I talk to business owners, I have to take the numbers in their P&L, the balance sheet, their cash flow forecast, and put them into a narrative that works for them. Because that's what I do. I'm rubbish at most everything else.
Apart from golf.
I'm rubbish at that as well.
That we've not seen, so we don't know.
Practice doesn't make perfect in golf,
Even with the visualization.
even with visualization.
Manifesting, yeah. Rob, in this season of the Century Plan, we're focusing on trying to work out what's stopping people from engaging with the financial planning process. So I just wondered what you think the main reason might be for that, what you've come across, and what you think we can do to overcome it.
So I guess there's a couple of things. I'm very aware of a lot of businesses, a lot of individuals. They're not out there. They're not recognized. They're not known about. And so I think a lot of it is lack of awareness, lack of understanding. It's numbers generally. It's something that makes people uncomfortable quite often if they're not conversant with it. And there's a lot of decisions to be made about, what is your longevity? How long are you going to live? Who are you going to partner up with? They're big decisions. I wrestled with one of my sons about investing in a pension, realizing that he should invest in a pension. It's a decision that you can put off for months or years, but really shouldn't. My father was a businessman, so I probably had a little bit of a head start. I saw him acquiring assets, acquiring stock, selling it, making money. And so I was very comfortable around that sort of world. I think for most people, whether you work in law or marketing or production, you're not around money and currencies and assets every day long. So it's a little bit alien to them. It's a little bit fearful. But I think a lot of it does come from a lack of understanding, being aware that time flies. You're 1 minute you're in your 30s with 2 kids, next minute you're in your 50s and they've left home and gone to college and they're doing stuff on their own. Time flies so quickly. And I think if you don't do things in your 20s or 30s, finding the right partner to marry or get together, finding the right assets to acquire in the right places. And if you don't have someone, a parent perhaps, or a family friend to advise you, you need someone to tell you, at your age, you should be doing this. You should have XYZ. You should be doing this. You should be looking at a mortgage or a pension or an ISA or another income, if you will, or you need to minimize your income, lower your income. You need someone to counsel you. But I think a lot of it does come to a lack of awareness of financial planning. For you and I, it comes naturally. For most people, it doesn't. And then it's also a fear of of numbers. Many people are fearful of numbers. It's just not something they're comfortable with. So I think it's a combination of those two or three things. I think the more that you do things like like your podcast, making people aware of things. There are some bad actors in the finance world. You guys are some of the best I've come across. That's why I wanted to partner with you. You do right by educating people. I think education's a huge part of it. People just don't leave high school or college with a level of financial independence that is, frankly, all of us probably agree it's frankly scandalous. They just don't
I think
understand.
you alluded to something a bit earlier, though, that you're saying there, is that when you go to work with your clients and businesses, is that you've got to take all of those numbers, the things that might be alien to the businessman who might know how to do a specific skill or deliver a specific service incredibly well, but doesn't understand the numbers. And you said, I have to present that in a way that they understand.
Right. You have to frame it in a business. You
Yeah.
have to frame it so that people in marketing, HR, legal, operations, the senior leadership understand and can conceptualize it. And it's the same with personal finance. You need to put it in a way that people will understand that if they get to their 60s and they no longer have an income, and by the way, you took 25% of your pension and spent it when you were 45 years old or 50 years old or whatever it is, you're going to struggle. Because the pension in the UK is nowhere near sufficient to live on. So you need to have acquired assets over time, and those assets needed to have had 20, 30, 40 years to grow to generate income that you'll need. And I think most people just can't think beyond the end of, it's Christmas in 3 months' time. My kids, 8, they're 10, they're 12, they're 18, suddenly they're going to college. And you get to 22, 23, your kids are 22, 23, and you think, well, okay, now it's for me now. We'll go on holiday, we'll buy cars. Little do they know when they get into their 50s, quite likely, it's very likely that you will be downsized and you will no longer be doing what you were doing when you were 30 or 40, when you're 55. You'll have to reinvent yourself and you'll have to generate new income streams. And you can't go back to your 20s and 30s and start shoveling money into a pension or an ISA. You've got to have done that when you're 25, 28, 35.
Yeah.
Because
And
you'll
neither
need
do you
it when
have the
you're
energy
55.
of a 25-year-old.
My goodness, you'll need it when you're 60 because you won't be able to do what you were doing when you were 30 or 40. And you can't go back there. So you need those skills. I mean, for example, I've reinvented myself now. I'm really just a board advisor, a non-executive director, and a CFO. That wasn't what I was doing 20 years ago. I was really heavily as a finance director of a $1 billion business in the US. Everyone pretty much has to reinvent themselves, I believe.
They do.
Do you think you've done that?
No, I've been doing this for the last 30 odd years. But the podcast's new.
Yeah, exactly. There's always something new to do.
There is.
Yeah.
You've got to.
And that's another thing. I mean, the podcasts I think are wonderful. I've been on 3 already in the last 6 weeks. I've got another couple coming up. They are so apropos, and it's part of that education and learning that people hopefully will engage with and will find insightful, and they'll reach out for support and advice and counsel.
Absolutely, Rob. Yeah. Well, I'm so glad you were able to join us on ours.
I thought we had it uniquely. I didn't know we'd
Do
be
you think it was exclusive? No.
Yeah, I did.
I talk about other things on other people's podcasts.
Pointing. No, seriously. Thank you so much, Rob, for joining us. That was so interesting, and I think we're sort of speaking the same language, don't you, Dennis?
We are from different sides of the equation.
Pleasure. Good to see you guys again as well. I think we're very much into it. It's about time. It's about investing. It's about automating. It's about making it a habit, because then you'll benefit in the long run. When you're 50, 60, retired, you'll be more comfortable. And it's about thinking about it early days and getting educated and partnering with people like yourselves.
Absolutely. Thanks, Rob. Enjoy the golf course this afternoon.